Hi everyone, and thanks for joining us for our first quarterly roundup of 2025. My name is Natalie, and today I will be hosting our South African Best of Breed managers. We'll be looking back on the whirlwind year that was 2024, getting some great insights from them, looking at what is top of mind going into 2025, and hearing about their portfolio positioning given their current views. Joining me first today, I have Lara Dalmeyer. Lara is the co-portfolio manager of the Nedgroup Investments Flexible Income Fund. The fund aims to outperform money market instruments using a diversified alpha approach by allocating capital across the fixed income spectrum locally and globally. Importantly, the fund is very conservatively managed and places significant emphasis on capital preservation. Thank you so much for being here today, Lara.
Thanks, Natalie. Thanks for having me.
Excited to chat about the fund and your views for the year.
Yes, always.
So, Lara, to start, I just have to comment on how great the fund performance was in 2024. Last year, you and I spoke a lot about what's appropriate in terms of risk in an income fund. We had a lot of conversations about how different funds in the sector are taking on more risk to get higher returns. And I think this fund is such a great testament to the fact that we can still preserve capital for our clients, but we're able to deliver that alpha for them. So maybe we can start by talking through the performance for the year and any contributors or detractors.
Thanks, Nat. Yes, we're very pleased with the performance of the fund for 2024. Pleasingly, it outperformed the benchmark, 110% of STEFI over the year by 1.2%, and it also outperformed the peer group average for the year. So a very pleasing result, and what's nice is that we can also see, if you look at the chart, just how alpha was generated across a variety of the asset classes within the portfolio, talking to the natural diversification in the income fund. What's also pleasing is that this return was generated, as you mentioned, with very low levels of risk. You will notice that through the year, the portfolio held very moderate levels of duration. The credit quality within the portfolio remains very high. We no longer invest in unguaranteed SOE debt. All of our credit is rated single A or higher. There's no unlisted credit. And it's a portfolio that is also very liquid. So we really are pleased with not only the return, but the quality of return that we managed to generate.
So I always love to hear your thoughts on the US economy. Many predicted a recession at the start of 2024, but that never quite materialized. And in fact, the real GDP in the US actually exceeded expectations of nearly all of the forecasts. Then we had the re-election of Trump as the president, which was arguably one of the most interesting events of 2024. The US economy just continues to rage on. It is so strong. What is sustaining this? And also, how does Trump coming in influence all of these factors?
Yeah, the US economy has been incredible, and as you mentioned, it just keeps seeming to steam ahead, regardless of how tight monetary policy is. I mentioned, a couple of months ago when we chatted that it almost feels like monetary policy has stopped working. You can see that through the inflation numbers, where yes, it has come down, but you aren't seeing inflation anywhere near target levels. I mean, we saw the last print, December print of inflation at 2.9, and core is still printing at 3.2. And it's very hard to tame inflation when the economy is running as hot as it is. So you really do need to start seeing a bit of a slowdown in the economy to think that inflation is going to move back down towards target sustainably. We have always been of the opinion that that is very difficult, because we believe that a lot of this high economic activity, higher inflation, is a result of fiscal dominance. And fiscal dominance is highly stimulatory, and there is nothing signaling to us that fiscal dominance is anywhere near an end. So why do we say the US economy is in a period of fiscal dominance? We say that because it's become very clear that these big structural deficits in the US are surpassing private sector lending or monetary policy as a tool for economic activity and inflation. So to fight fiscal dominance with monetary policy, we believe likely will continue to be unsuccessful. That is why, despite being interest rates being very high, you are seeing economic indicators like the non-farm payroll continue to print very high numbers. Just to give you an indication, we believe that in order to see some kind of rollover, you need to be seeing prints of about 100,000 to 150,000. The last print was still over 250,000. So we expect that to continue, and we therefore expect inflation to struggle to move lower. As you mentioned, Trump, although he certainly didn't invent fiscal dominance, we think fiscal dominance would have been a theme regardless of which party came into play. He does, however, exacerbate that. Deficits under Trump, we believe, look to be higher, despite what they're going to try and do through the Department of Government Efficiency. And his policies by nature seem to be more inflationary, whether these are once-off inflationary shocks or longer, what the size of those will be. Unfortunately, the market's also treading on eggshells a bit because we aren't really sure what to expect. But in general, we do expect it very hard for the US economy to taper and for inflation to taper under current conditions.
So yes, prior to Trump being elected, we spoke about how his policies are inflationary. As you just mentioned, the US is struggling to get inflation under control, and we've just had an uptick in the latest inflation print. So even before this, we saw the tempering of rate cut expectations in the US. So what can we expect to see going forward with all of this that's going on?
Well, I mean, the rate cut expectations by the market have reduced drastically, and it's even reduced significantly if you look at the Fed. If you look at what the FOMC members are expecting for rate cuts in the December meeting versus what they expected in the September meeting, which would be the light green line, you can see just how many fewer rate cuts they themselves are expecting for next year and the years to come. What can we expect from inflation? As I mentioned previously, we think it is very hard to temper, but it's important to understand why we think that. The persistent stickiness in inflation is coming from the core services portion of the inflation basket. And the large driver within that portion is owner's equivalent rent and rent in general. Mm-hmm. Those two portions of the basket have been hugely sticky, and there have been numerous predictions that that is going to roll over. In the November print, despite the print being a little bit higher than inflation, that portion of the basket actually pleasantly surprised people. And that was a bit of an indication to the market that, okay, maybe that concern is tapering slightly. Ironically now, since the December print came out, that print was slightly lower than the market expected. But if you look into the constituents, the housing element, the rent and OER element, those two were slightly higher than expected, which again is signaling actually that hasn't resolved itself yet, and that there is a high likelihood of persistent stickiness to continue. What did surprise on the downside was the core goods portion of the basket for the December print. But as we mentioned, we've got potential tariffs coming. The risk in the basket is in the core goods portion. So I don't exactly rest easy that now, just because the December print was slightly lower than expectations, that inflation is on its way down. The problematic portions remain problematic, and the element that's slightly surprised on the downside is where the upward pressure is likely to come from Trump policy. So inflation in the US is, we believe, problematic, and it will continue to be a huge theme throughout this year.
So last year at some point we had 100 basis points rate cuts priced into our market, but obviously we know that SA is quite heavily influenced by the US rates and what the Fed's doing. The SARB seems to always be moving in lockstep with them. So how does their tempering of their expectations now affect our market in terms of what we could expect for local rates, especially considering the fact that we don't seem to have an inflation problem? I mean, if our inflation looks to be under control, so one would think we could actually afford to cut rates more.
Yeah, you're right. So if you look at our FRAs, and I've shown the FRA curve there on the slide, you can see that rate cut expectations have moderated here quite significantly as well. And interestingly, the market thinks that it's only got one more cut priced for the rest of the cycle. So that is very low. The market thinks one more 25 basis points and the SARB may have to stop. And that is absolutely 100% attributed to what is going on in US monetary policy. We agree with the market's concern. Whether it is only one more, we can't be 100% sure, but we agree with the market's concern that SARB can't move if the Fed doesn't move. That interest rate differential, in our opinion, is just not high enough for us to move to any considerable degree if global base rates remain high. And the reason for that is we need to compensate investors for investing in South Africa. We are a higher risk nation with higher risk instruments. So obviously you do have to offer them that risk premium. And if that risk premium is not there to a substantial degree, that threatens local assets. It threatens the rand, it threatens local markets, and naturally that feeds through into inflation. So the SARB unfortunately has its hands tied if global rates, particularly now the US, does not move rates lower substantially. So it is a difficult conundrum for the SARB because, as you mentioned, our inflation isn't problematic. As a matter of fact, they themselves don't see inflation reaching the midpoint of the target band this year. And if you look at a variety of other estimates, the majority of estimates don't have inflation reaching the midpoint of the target band for most of the year, perhaps potentially only towards the end of the year. So from that point of view, you would think they do have room to cut. But I think global rates are unfortunately driving that narrative. I just want to put a little caveat on inflation though, and I think maybe the market or people haven't quite appreciated the fact that there is quite a high degree of uncertainty around our inflation now. Our basket has been already reweighted for January, although we haven't seen the announcement of what those weights are yet. We know that there is a change coming, and we're not quite certain. Our ability to predict what inflation will be is a bit hampered at this point in time because we haven't yet been told exactly what the composition of the inflation basket is going forward. So there is also a bit of uncertainty in that regard, and hopefully will be clarified soon. We will know towards the end of the month.
So you previously mentioned the country risk premium. What is your view on SA government bond valuations at the moment then, given this kind of recalibration in rate expectations? And you've been positive on short-term SA linkers before. You were seeing quite a lot of value there versus nominals. So is that still your view?
Yeah, so that is still our view. If you look at the chart, we have put a rough table there on a 10-year nominal bond valuation. If you look at where the SA 10-year yield is trading, and you kind of back imply what the market is pricing for the risk premium, depending on whether you use 5 or 5.5% inflation, we work out that the market is pricing about a 2.5 to 3% country risk premium. We do believe 5% is probably a more appropriate long-term inflation number. So that means that the market is implying around about a 3% country risk premium. In our opinion, it's slightly on the low side. There has been a lot of positivity around SA post-GNU, and we think a lot of that is founded, but it will take a bit of time for all of that to come to fruition. So although we think that the risk premium is slightly on the low side, we do think that global rates are probably slightly on the high side. So largely those cancel each other out. So our view on local nominal bonds is that they are trading very much in fair value. We think that there is, probably a bit more value in the belly to longer end than in the short end, but generally this portfolio doesn't go too far out on the yield curve. In terms of linkers, we've also shown you the break-even levels there. What does that mean? It means that when break-evens are low, your preference will generally be for inflation-linked bonds. Where break-evens are high, your preference will generally be for nominal bonds. And you can see the inflation break-evens on the short end of the curve are quite low. I think the market does have a little bit of, let's say, short-term memory bias in that the lower inflation prints that we're seeing recently, I think, is making the market worry that we will see those more persistently. Our view is that SA does have some structural inflationary pressures that, although largely due to base effects, we aren't seeing those now. We do think that maybe longer into the future, the risk there persists. So, at real yields over 4.5, we are happy to hold short-end inflation-linked bonds, and the portfolio does have a reasonable allocation there.
Are you concerned about the SA economy at all? Because you mentioned there's so much positivity going around, but we have some serious structural challenges still.
We do. I am positive. I think that we have seen, a lot around structural reforms, and we can see positive momentum in that regard. So I'm certainly not negative. I think that maybe potentially the market at times has gotten a little bit ahead of itself. That's not to say that, a country risk premium of 3 or 2.5 is incorrect in the future. It's just our belief that we are not there yet. And I think, the budget or the MTBPS was a reminder of that. We are still struggling from a fiscal point of view. Hopefully some growth is reinvigorated and that will improve that picture. But again, this takes time. So I am positive. I just think that we just need to remain practical about, where we actually are and how quickly this could potentially happen. And although the market may have been a little bit negative about the MTBPS, I think that was almost unfair. I think the market expectations were unreasonable. So from what we saw, there is still a very reasonable plan in place to get deficits under control and to run primary surpluses. We can see the debt to GDP trajectory, slowly starting to taper, and the budget was conservative. So we believe that, what they set out to the market is actually realistic. So we're positive. But at the back of our mind, just also want to remain practical.
You've got a lot of tools available for you to use in constructing the portfolio. Diversification is key, and there's so many different asset classes that you can use. So hopefully there's many opportunities out there for you. So how have you pulled this all together in the portfolio construction?
So as always, as you mentioned, we focus on diversification. And if you look at the portfolio positioning, we think that's evident in just how a diverse variety of asset classes we are invested in. We have almost 43% of the fund in floating rate bonds. That is an asset class that we are very fond of. There's a very high credit quality element in that basket, so we are not concerned about credit risk. There's no duration risk, and that portion really does deliver a nice 1.6-1.7% about the money market for the fund. We then have an allocation to SA nominal bonds, to South African government bonds predominantly, and that translates into about a 0.6 year duration for the fund. We believe that there may be a little bit more value there, through what happens with global rates, but we have taken a lot of duration off as we have seen the significant rally in local bonds. We do have about 0.4 years duration in SA inflation-linked bonds, and as I mentioned, that is predominantly in short-end linkers, where we are managing to pick up short-end instruments at real yields of above 4.5%. We then also have 0.3 years offshore duration. Offshore duration, although oftentimes you may have to take a bit of a yield leak, we do try and get that yield as competitive to local yields as possible. We think there is a higher potential there for a rally, and also it provides a very nice diversification element to the portfolio, because when you do have global risk off, as local assets suffer, generally instruments like US Treasuries or TIPS rally. So those do provide a very, very nice diversification element to the portfolio, and for that reason we have 0.3 years duration there. SA property, we have 1.6%. We have trimmed our property exposure again into strength. We think a lot of the easy ones in that sector have likely been seen already. And just to emphasize, although it looks like we might have closer to 14%, 15% in offshore bonds, please note that the vast majority of that is hedged back into rands, and the fund's effective offshore exposure is only sitting at 2.7%. As the rand trades towards 19 or closer to 19, it is our view that the rand is trading cheap in that territory, so we would prefer to hold less dollars in that environment, hence the very low dollar exposure you see in the portfolio at present. So yeah, we think the portfolio is well positioned, and yeah, we look forward to the year and all the prospects.
Thanks, Lara. Sounds like a really strong, robust portfolio. With all the different drivers of return, it's really hopefully resilient and able to withstand all the different market conditions, and that's what we need going into 2025 for sure.